for the introduction, and good afternoon, everybody. It's great to be here today. I wanted to talk about profiting in down markets. We've had a pretty long bull run here for the last 10 years or so, but we're currently facing a down market, and we wanted to discuss the strategies we use in a down market. Today we'll look at the best stocks and ETFs to short if you want to take short positions. We'll look at a system for selecting bearish trades, and we want to limit our risk on bearish trades to the cost of the trade. That's very important when you're short. You don't want to just be short a stock or short an option because you face unlimited risk if the stock continues to increase in price. So that's a very important part of short positions, is you want to make sure you use limited risk short positions and you're only risking the cost of the trade. And we'll have a Q&A session at the end. I'd be glad to answer any questions. So the strategies we'll look at today are put option purchases, bearish debit spreads. We'll look at our profit guard strategy and married puts. And we're going to look at several ways that can increase your percentage of winning trades. And a higher percentage of winning trades can give you the discipline needed to become a successful trader. So over the years we've developed certain systems that allow us to increase our percentage of winning trades, and that helps a lot with our discipline that we maintain to stay consistently profitable in any kind of market. And I'll show you a snapshot of our portfolio, brokerage account portfolio report with $901,000 in open trade profits for the profit guard strategy. And this report will list the stocks and options that we own, the current price, the profit, and the percent return. So we are making money in these down markets. Here's a snapshot, and we'll look at this in a little more detail later on, but this is open trade profits for the profit guard strategy, where we list the stock or the option, the total gain in this column, and the percent return. And I also want to take a look back. We've had our advisory service in place for about 20 years now, and we started it right at the beginning of the dot-com crash. So you can see those years the advisory service was profitable. Of course, we had the market meltdown in 2007 and 2008, and these are the yearly profit results for our advisory service in this column here. And you can see we were profitable during the market meltdown. 2011, we had that 18% correction. We were profitable. And then in 2018, we had two major corrections, and we were profitable in 2018. So I just wanted to show you that these strategies that we're going to look at today did get us through these bear markets and market corrections with profits. And all the strategies we'll discuss today, as I mentioned, are limited risk strategies, and you can't lose more than the cost of the trade. Of course, if you short a stock or a naked call option, you incur unlimited risk, as you can lose more money than you invest. And this can result in a margin call, so we don't want to go down that path. And the best stocks to short, we found through experience, are growth stocks with little or no earnings. Those are the best candidates for short positions, obviously, in a market downturn. So we like to focus on those growth stocks with high PE ratios, which normally decline the most during bear markets, and you can profit with short positions. So let's take a look at a couple examples of high PE stocks. This is a daily price chart here of Spotify, and Spotify has no earnings. Of course, it's been selling off in this recent downturn. You can see it went from about $200 a share down to about $115. Here's another example, Netflix, a high PE stock, PE of 90, went from about $410 a share to $250 a share. So these are just examples of high PE stocks. This is Alibaba. You can see that went from about $210 down to $135. So those are the stocks that you want to focus on in a market downturn. So let's talk about our first strategy, and that's a put option purchase. A put option purchase, of course, is a bearish strategy, as the value of a put option increases as the underlying stock or ETF decreases in price. Your risk is limited to the cost of the put. This is a much lower risk strategy than shorting a stock, which incurs unlimited risk if the stock continues to increase in price. And normally a margin account is not required for put option purchases. And we normally initiate put option purchases with about 1 to 3 months until expiration, and most put options cost between $500 to $1,500. They could be a little more expensive on those really high-priced stocks, but generally somewhere in the $500 to $1,500 range. And you can trade a portfolio of put options in a $5,000 trading account. So we're going to look at the selection process we go through to select a bearish trade. And we have a 3-step process to select bearish trades, and we use the 10-month simple moving average trend following system for selecting stocks for put option purchases. So with this 10-month simple moving average, we want to identify a stock that's moving down in price, and then we can profit by purchasing a put option. So step 1 is we determine the price trend of a stock using the 10-month simple moving average system. Step 2 is we confirm the price trend using on-balance volume. And the third step is we use the 1% rule to select the put option strike price for a higher percentage of winning trades. Okay, let's look at step 1, determining the price trend of a stock using the 10-month simple moving average system. And we use the 10-month average to identify the price trend of a stock, and that allows us to trade with the trend instead of trying to predict the future price movement of a stock. The 1-month price of a stock in relation to its 10-month simple moving average is a great way to identify the major trend of a stock. Now, you may recall from previous webinars for bullish trades, we use the shorter term 50 and 100-day EMA system for selecting trades to purchase call options, but we found the longer term 10-month simple moving average is more profitable for selecting bearish trades. The 10-month simple moving average has fewer whipsaw trades that occur when counter trend rallies stop you out of your short position. So if you're going to take a short position, we like to use a longer term trend following system, and the 10-month simple moving average is a great way to identify the longer term trend if you're going to be taking a short position. So if the 1-month price of a stock is above the 10-month simple moving average, then a bullish trend is indicated, and if the 1-month price is below the 10-month simple moving average, a bearish trend is indicated. So for put option purchases, we only want to focus on stocks or ETFs in a price downtrend with the 1-month price below the 10-month simple moving average. And we only look at the 1-month price of a stock in relation to the 10-month simple moving average, and we only look at it on the last trading day of the month, and we ignore all the other trading days. So it only takes a few minutes a month to check that price trend to see if that stock is in a downtrend. And as we mentioned, if the 1-month price of a stock is below the 10-month simple moving average on the last trading day of the month, then that stock is on a sell signal. So the price movement of a stock reflects all of the known information about a company. So we use that 10-month simple moving average system to measure that price movement of a stock. So all the known information about a company is reflected in that 10-month simple moving average. So if you can quantitatively measure that price movement, then you can benefit from trading with the trend. And you can download the 1-month, 10-month simple moving average from pricecharts.com with the basic subscription. Let's look at an example of a sell signal. This is for the social media ETF, symbol SOCL, and on this price chart, this black and red line right here, that's the 1-month price of a stock. So you can see in September the ETF was trading here, in October the ETF was trading here. So this is the 1-month price of that ETF. And this blue line is the 10-month simple moving average. So we can see that the social media ETF was on a buy signal, but then it crossed below that 10-month simple moving average in July. So at that point it was on a sell signal, and you want to consider taking bearish trades with the social media ETF. So right in here, 1-month price crossed below the 10-month simple moving average. And you can see it fell from about $33 a share down to about $27 a share since the sell signal. So we want to buy put options on stocks or ETFs that are on a 10-month SMA system sell signal. And when you use this trend following system, we're using a system instead of using emotional decision making, and we've been using trend following successfully for more than 30 years, and the trend following worked well in the 2002 and 2008 bear markets, as you could see from our advisory service results when we had short positions during down markets. And a trend following system also eliminates emotional decision making, and instead it gives us the discipline we need to be successful option traders. Okay, so step one is we identify the price trend. We want to make sure the stock is in a downtrend on a sell signal if we're going to take a bearish position. And step two is we want to confirm the price trend using on-balance volume line or the new 52-week low list. So once we determine a stock is on a sell signal, we want to confirm that price trend. An on-balance volume measures volume flow with a single easy-to-read line, and volume flow always precedes price movement and helps sustain the price trend. And the way the on-balance volume line is calculated is when a stock closes up for the day, volume is added to the line, and when a stock closes down, volume is subtracted from the line. So a cumulative total of these additions and subtractions form the OBV line. So let's look at an example of it. This is the daily price chart of the social media ETF, these vertical red and black lines right here, and below here is the on-balance volume, and you can see that the on-balance volume has been in a steady decline. So the line is sloping down. So if we're going to take a short position, we want to confirm the price trend and make sure the OBV line is sloping down. So when the OBV line is sloping down, volume is heavier on days that the stock closes down, and volume is lighter on the days a stock closes up. So it's an indication that the selling pressure is exceeding the buying pressure, and it confirms the price downtrend. And you can also download the OBV line from stockcharts.com. And we simply use the default parameters for the OBV line. So the default parameters on the website is what we use for the on-balance volume. And we also like to confirm the price trend by the new 52-week low list. So we found that stocks that are making a new 52-week low are in a powerful downtrend, and they tend to continue their price downtrend. So that's a second way to confirm the price downtrend, is to see if the stock is making a series of new 52-week lows. And you can see with the social media ETF that this is a one-year daily price chart of the social media. You can see that it's making a series of new 52-week lows. And you can download the new 52-week low list from barchart.com. You just click lows, and it'll list the 52-week new lows. And this list is also a good starting point if you're going to be looking for bearish trades. You want to look at the list of stocks that are making new 52-week lows as candidates for short positions. Now let's talk about increasing the percentage of winning trades. And we do that with step 3 of Prime Trade Select. And we use the 1% rule to select a put option strike price that will result in a higher percentage of winning trades. So once you select a stock for an option purchase, you have to select an option strike price. And depending on the stock, there could be hundreds or even hundreds of thousands of strike prices available. So the question is, how do you determine which strike price to use? And option premiums consist of time value and intrinsic value. Now, each day before option expiration, the time value portion of an option decays, and the greatest amount of time decay occurs in the last 30 days before option expiration. And at option expiration, options lose all time value and consist of only intrinsic value. And here's a graph of a typical time decay characteristics of an option. And this line right here represents the time value portion of an option. And you can see that it decays as you get closer to option expiration. With the last 30 days, you have the most time decay. And then when you get to expiration, the time value goes to 0. So options lose all time value at expiration and consist of only intrinsic value. So when you buy an option, you're buying a decaying asset. So you always want to keep that in mind. And due to the time decay characteristics of options, when we buy an option, we want to minimize the time value, which will decay to 0, and we want to maximize the intrinsic value. So the overall goal is, when you're choosing an option strike price, is to minimize time value that will decay to 0 and maximize the intrinsic value. And the best way to minimize time value and maximize intrinsic value is to purchase in-the-money options. In-the-money options have more intrinsic value, and they have less time value than at the money or out of the money options. And we'll show you an example of that. This is a option chain for the QQQ NASDAQ ETF, and at the time we took the snapshot, the QQQs were trading at 147, and this is a list of put option strikes here on this first column and the bid and ask price for each strike price. So with the QQQs trading at 147.57, the closest strike price to the current price would be the 148 put. So that would be considered the at-the-money put. It's trading closest to the price of the ETF. And the lower strike prices, the 147, 146, 145, they would be out of the money put options. And the 149 and higher strike prices would be considered in the money for put options with the QQQs trading at 147. So as I mentioned, in the money options have more intrinsic value and less time value than out of the money or at the money put options. So the way you calculate the intrinsic value of a put option is you subtract the strike price from the current price of the ETF. And if you subtract the strike price from the current price, you get the intrinsic value. So here's another snapshot of that QQQ option chain, and what we did was we calculated the intrinsic value in this column and calculated the time value in this column. So in the first row here, we can see that the 148 strike put has an intrinsic value of 43 cents. And the way we calculated that was subtracting the current ETF price of 147.57 from the strike price of 148. So we subtracted the ETF price from the strike price, and we came up with 43 cents of intrinsic value. And as you can see, as we get deeper in the money with the put strikes, the intrinsic value starts increasing and the time value starts decreasing. And the way you calculate the time value is you subtract the intrinsic value from the option premium. So in this column right here, we list the time value, and the way that's calculated is you subtract the intrinsic value of 43 cents from the price of the option of 8.58, and we come up with a time value portion of 8.15 for the 148 strike put. So again, notice as the option gets deeper in the money, here's the at the money strike right here at 148. So 149 and higher, these are all in the money put options, and you can see the deeper you go in the money, you can see that the intrinsic value starts increasing and the time value starts decreasing. So we developed a simple technique we call the 1% rule for selecting an in-the-money strike option when you're purchasing options. And the 1% rule utilizes a strike price that limits the time value portion of an option to less than 1% of the stock price. And if you do that, you'll be minimizing time value and maximizing intrinsic value. So what the 1% rule is, we want to limit the time value portion of an option to less than 1% of the stock price. And using our current QQQ example, the QQQs were trading at 147.57, so 1% of that would be 1.47 points. So what we want to do is limit the time value portion of that option to 1.47 or less, which is 1% of the current ETF price. So we can see the 168 strike put has a time value of 1.43, which is less than 1.47. So this 168 put would qualify because it's less than 1% of the current ETF price, and the deeper you go into the money, the less time value. So the 168, 169, 170 strikes all have less than 1.47 points of time value, so they would qualify under the 1% rule. Now, if you limit the time value portion of a put option to less than 1% of the stock price, the stock only needs to decrease 1% in order for the put option trade to start profiting. And a 1% price decrease to profit, that has a much higher probability of being profitable than an at-the-money or out-of-the-money strike price that requires the stock to decline 5 to 10% or more in order to start profiting. So 1% move in the stock or ETF to the downside with a put option, and we start profiting. So that's going to have a much higher probability of success than if the strike price required a 5 to 10% or even greater move in the ETF to start profiting. Many times the expected stock price move will not occur before option expiration. And when you use the 1% rule, the value of the option will increase $100 for each 1 point decrease in the stock or ETF price. And remember, if you purchase an at-the-money or out-of-the-money strike put option and the stock is flat or up at option expiration, it will result in 100% loss of the premium. So you always want to keep that in mind if you buy at-the-money or out-of-the-money strike puts and the stock closes flat or closes up, you'll lose 100% of the option premium. So we try to avoid that. So using that 1% rule to select an option strike price will increase your percentage of winning trades compared to trading at the money or out of the money strike puts. And this higher accuracy will make you a more successful trader. So you always want to keep in mind the time decay characteristics of options, and you want to select a strike price that only requires a 1% move in the stock in order for the option to start profiting. So let's look at an actual option trade and that will demonstrate the profit-loss characteristics of the option purchase and illustrate the 1% rule we used for selecting the option strike price. This is a monthly price chart of the Chinese Internet ETF, symbol KWEB, and we can see the monthly price drop below the 10-month simple moving average right here. So KWEB was on a sell signal at that point. The major trend was down, and we used the 1% rule to select the strike price. So this is a copy of our brokerage statement, and this is the orders in our online brokerage account. And you can see that we purchased the KWEB 52 strike puts at $13.50. So bought to open 8 of the KWEB February 52 puts at $13.50. And KWEB was trading at $38.68 at the time we purchased these puts. So the Hughes Optioneering Team, we designed a series of calculators to calculate the profit potential for 6 different types of option strategies. And these calculators allow us to know the profit loss potential of an option trade before we take the trade. And the calculators will calculate the profit potential for an option trade based on the price change in the underlying stock or ETF at option expiration. Now let's look at the put option calculator, and you can see that we input the current stock price of KWeb when we purchased the put was at 38.68, and you could see from the brokerage confirmation that we bought the 52 strike put at 13.50. So we input this into the calculator, and then the calculator will calculate the profit potential based on the price of KWeb ETF at option expiration, in this case from a 30% decrease in the ETF to a 5% increase in the ETF. So it'll base the profit, it'll estimate the profit based on these different price changes in the ETF at option expiration. And the bottom row here lists the percent return for the option, and the second from the bottom row right here lists the dollar return for the option. So we use this calculator to calculate the profit potential for this option purchase, and we can see that if KWeb is down 30% at option expiration, we'll have an 84% return and an $1,100 profit. And if KWeb goes down 10% to 34.81, we'll have a $369 profit and a 27% return. So this will calculate your return potential based on various assumptions in the price movement of KWeb at option expiration. And the calculators will also calculate the time value portion of the option and the intrinsic value. So we purchased the option for $13.50, and it has $13.32 of intrinsic value, and it has 18 cents of time value. So in this case, if the option premium is $13.50, the 1% rule would call for us to limit the time value portion of the option, or with the ETF trading at 38.68, the 1% rule would limit the time value portion of the option to 38 cents. And you can see it's at 18 cents, so it's less than 1%, so this trade qualified using the 1% rule. So the 18 cents of time value is less than 1% of the stock price and meets our criteria of limiting the time value portion to less than 1%. So this allows us to minimize the time value and maximize the intrinsic value. So in this example, KWeb only have to decline 18 cents in order for this trade to break even and start profiting. And we can see that if KWeb is down 1%, we'll actually have a profit for the 1.5%. So again, that confirms that we use the 1% rule, because in this case, if the ETF goes down 1%, we profit at 1.5%. And if the ETF is flat, we lose 1.2% on the option. So that's another way to confirm the 1% rule, is just to plug in a 1% decline, and we can see that the option would be profitable. So the analysis reveals a 1% decrease in the stock price results in an option profit. 20% decrease is a 56% return. 30% decrease is an 84% return. And a flat stock price is a 1.3% loss on the option. Our total risk is limited to the cost of the option, and the profit potential is unlimited. So let's review the advantages of using the 1% rule. If you use the 1% rule, the underlying stock or ETF only needs to decrease 1% at option expiration for the option trade to profit. A 1% stock price decrease to produce a profitable option trade obviously is going to have a much higher probability of success than an at-the-money or out-of-the-money strike that can require the stock to decline 5, 10, 15% or greater in order to break even and start making money. So we like to select option strike prices that only require a 1% move in the underlying stock to start profiting. And many times the expected move in a stock to decrease 5 to 10% or more will not occur before option expiration, and this could result in 100% of loss on your option trade, so we want to try to avoid that. So using the 1% rule to select an option strike price, that will increase your percentage of winning trades compared to trading at the money or out of money strike puts. And a higher percentage of winning trades can give you that discipline needed to become a successful trader. So the put option strategy is one of the several strategies we use in down markets. And again, here's a snapshot of down markets. They're highlighted in yellow here, and you can see that our advisory service was profitable during the dot-com crash right here. It was profitable during the market meltdown 2008, and it was profitable in 2018 when we had two major corrections. So let's look at our next strategy, bearish strategy, and that's bearish debit spreads. And a bearish debit spread can profit if the underlying stock or ETF is up, flat, or down at option expiration. And with a bearish debit spread, we buy an in-the-money put option and we sell a related put option with a lower strike price with the same expiration date. So to set up a bearish debit spread, you buy an in-the-money option, put option, and sell a put option with a lower strike price. And the put option purchase and sale can be done simultaneously, or you can purchase the put and then sell a put at a later date to leg into the spread. So we're going to look at the simultaneous version of this strategy where you simultaneously buy the put and sell the put. So if you establish a bearish debit spread, the put option that you purchased will profit if the price of the underlying stock decreases, and the put option that you sold will profit if the price of the underlying stock increases. And your risk is limited to the cost of the spread. And we normally initiate debit spreads with 1 to 3 months until option expiration. Most of the spreads are in the $700 to $1,200 range to establish a put option debit spread. So you could trade a portfolio of these debit spreads in a $5,000 trading account. Now with bearish debit spread, the full profit potential of the spread is realized if the underlying stock closes at or below the strike price of the put option sold. And if you sell an in-the-money put, the price of the underlying stock does not have to decrease in order to realize the full profit potential, and we'll show you an example of that here shortly. And most of the time, we can realize a 30 to 40% return if the underlying stock is flat at option expiration, and also profit if the stock is up as much as 10% at option expiration. So we'll show you an example of that. So obviously you're going to have a higher percentage of winning trades compared to a directional trade, put option directional trade, if you can profit when the underlying stock is up, down, or flat. And this will give you a higher percentage of winning trades compared to directional trades. And again, that can give you that higher percentage of winning trades, can give you that discipline needed to become a successful trader. A directional put option trade requires the underlying stock to decline in price in order to profit. So when you take a directional put option trade, the underlying stock has to decline in order for you to profit. And if you purchase a put option and the underlying stock closes at or above the strike price of the put, then you'll realize 100% loss on your trade. So with directional trades, if the underlying stock closes at or above the strike price of the put, you have 100% loss. But with these debit spreads, you can profit if the stock is up, down, or flat. And debit spreads are a way to profit in down markets, and we use them during the 2001 and 2008 bear markets to profit from bearish trades. So let's look at an example of a debit spread trade. And we use the simultaneous method for this trade of entering the debit spread, where we purchased the put option and sold the put option simultaneously. So let's look at NVIDIA Corp, symbol NVDA, and this is a price chart of the 1 month price right here, and this blue line is the 10-month simple moving average. So we can see the 1 month price cross below the 10-month simple moving average in October. So at that point, NVIDIA was on a sell signal according to our major trend system. And we can see from the daily price chart that NVIDIA was making a series of new 52-week lows, which confirmed the price downtrend. And we can also see the on-balance volume line sloping down, and that also confirmed the price downtrend. So NVIDIA was on a confirmed prime trade select sell signal, and this is a copy of the order we used to, our brokerage account order, to establish this debit spread. And when we entered the trade, NVIDIA was trading at 134.67. So we put this spread order in, and that allows us to save on commissions and also on the transaction cost between the bid and ask price of the option. So we put this order in to buy to open 10 of the March puts, 165 puts, and sell to open 10 of the March 150 puts. And this shows our executed price orders right here, and the brokerage confirmation shows that we did buy to open 10 of the March 165 puts at 35.03, and we sold to open 10 of the 150 puts at 23.98. So this created a bearish option debit spread. So bought to open the 165 put and sold to open the 150 put to establish a bearish debit spread. And the video you saw on the brokerage order was trading at 134.67 when the trade was initiated. So we bought the 165 put and we sold the 150 put. So this was an in-the-money spread. So if the strike price is above the price where the ETF was trading, then it's in the money. So this was an in the money debit spread. So again, bought to open the 165 put 35.03, sold to open the 150 put 23.98. So the net debit for this spread was 11.05, and the cost was $1,105 to initiate this spread. Now, in the money, put spreads give us more upside protection in case the stock rallies, and this gives us a higher probability that the trade will be profitable compared to an at-the-money or out-of-the-money put spread. So we always want to trade in-the-money put spreads. We have more upside protection, and we have a higher probability that the trade's going to work out. So bearish in-the-money spreads can profit if the underlying stock is down or up as much as 10% at option expiration. And we have a calculator to calculate the profit potential for bearish debit spreads. So we used our calculator before we took this trade, and you can see we input NVIDIA was trading at 134.67. We bought the 165 strike put at 35.03, sold the 150 strike put at 23.98, and it will the calculator will calculate the profit potential for this trade, assuming various price changes in NVIDIA at option expiration. In this example, from a 10% decrease in the stock to a 10% increase at option expiration. And in our calculator, the bottom row lists the percent return potential for the trade, and the second from bottom row lists the dollar profit for the trade. So we can see from the calculator that if NVIDIA stock is flat at 134.67 at option expiration, we're going to realize a 35.7% return. And this is a bearish trade, so if NVIDIA is down at all at option expiration, then we'll realize the full profit potential of $395, which translates to a 35% return. So stock is flat, we get a 35% return. If it's up at all at option expiration, we get a 35% return. Now, if the stock rallies and closes at up 10% at 148.14 at option expiration, we'll still realize a 35% return for this bearish trade. So again, NVIDIA can be flat, it can be down, or it could be up as much as 10%, and we're still going to realize a $395 profit, 35% return. So now let's think about this. If you can profit 35% when your stock is down, flat, or up 10% at option expiration, this will give you a higher percentage of winning trades compared to a bearish directional trade, which requires the underlying stock to decline in order for the trade to profit. So again, this will give us a higher percentage of winning trades because we can profit if the stock is down, flat, or even up 10%. So just remember, if you take a directional trade, again, if you purchase a put option and the underlying stock closes at or above the strike price of the put, you realize 100% loss on the trade. So these spreads will give us a higher percentage of winning trades compared to directional trades. And in-the-money spreads, as we mentioned, give us more upside protection, and that will result in a higher probability that the trade will be profitable. So the bearish debit spread is one of the several strategies we use in down markets, and what I did is I took a snapshot of our advisory service debit spread portfolio, current portfolio, and we can see this lists the stock here that we have the debit spread on, the dollar profit here, and the percent return here. So as of yesterday, we had $110,000 open trade profit and an average return of 212% in our option debit spread portfolio. And we make trade recommendations for debit spreads with our weekly option alert trading service. And if you want to get updated on the current profit results for the various strategies, you can see here, right here is option spreads. We also have market neutral, covered calls, option purchases. If you want to get updated on how these strategies are working, you just log on to weeklyoptionalert.com and click the trade results page, and it'll update you on the current profit results. Or you can call our sales partner, Brad, at his toll-free number or his 310 phone number. So if you want to just take a look at how the various strategies are performing, you just log on to the website and click trade results. Okay, and let's look at another strategy we use in down markets. We call it the profit guard strategy. And one of our portfolio management rules calls for us to protect profits whenever we have a profitable stock or option directional trade. So if we purchase a stock and we have a profit, then we want to create a spread to protect that profit by purchasing a put. And if we purchase a call option and we have a profit in the call option, we want to protect those profits by purchasing a put option. So whenever we have a profitable direction trade, we create a spread trade to help protect our profits. And when you purchase that put option, that gives you protection that enables you to profit in down markets even if your stock or option declines substantially. And we'll show you some examples of that. And as you'll see shortly, buying that put option for protection can, in many cases, can even guarantee that you'll have a profit for your trade regardless of the price movement of the underlying stock or ETF. So if we have a profitable directional trade, we always want to establish a spread trade, a profit guard trade to protect those profits. We'll look first at the profit guard option strategy. We also trade this for stocks too, but we'll look at the option strategy first. So Prime Trade Select has produced a lot of profitable call option trades over the years, and when you have a profitable call option trade, that always poses a dilemma. Do you hold on to that winning call option trade for further upside profit potential, or do you take profits in case the stock declines in price with the possibility of a profitable trade turning into a losing trade? And we know from experience that it's very difficult to watch a winning trade develop into a losing trade. This is hard on your psyche as a trader, and it can help you lose confidence in your ability to be a successful trader. So nothing's worse than seeing a profitable trade turn into a losing trade. So the profit guard spread strategy solves this winning trade dilemma. And what we do is we hold on to our profitable call option, and that will continue to profit if the underlying stock increases in price. And at the same time, you're protecting those profits in a down market. So if we go into a down market, by purchasing that put option, that protects your profits in your call option trade. And put options profit as the price of the underlying stock declines. And if you have a winning call option trade, purchasing a put option provides a profit guard that can help protect you against losses for your call option investment in the event the underlying stock declines in price. So when you have a profitable trade, you always want to protect those profits by purchasing a put option. And at the same time, purchasing that put option does not limit the upside profit potential on your call option if the underlying stock continues to increase in price. So once you establish this profit guard spread, bad earnings reports don't matter anymore. A severe sell-off in the markets actually produces windfall profits with this strategy, and there's no need to worry about placing protective stops. You don't have to worry if there's a big decline in the stock market when you have that put protection in place. So you can literally place that trade, and once you buy the put, you can ignore the trade until option expiration. And as we'll see in a minute here, purchasing the put option insurance can even guarantee that you'll be successful with your trade. So this transforms option investing from one of the riskiest investments to one of the lowest risk investments by purchasing that put option. Now, because there's a long position, which is the call option that you purchased, and a short position, which is the put option, this strategy is also known as a market neutral spread. And market neutral spreads can profit if the price of the underlying stock goes up, down, or remains flat. And a sharp decline in the price of the underlying stock can result in a windfall profit. And your risk is limited to the cost of the spread. You can start out with a $5,000 trading account, and we normally go out 1 to 3 months on a trade. So let's look at a trade example. This is for the healthcare ETF, symbol XLV. The healthcare ETF was on a prime trade select buy signal. So our online brokerage report shows that we purchased 64 of the 50 strike calls at 960. So it was on a prime trade select buy signal, purchased the 50 call at 960, and the trade was profitable, so we created a spread to protect the profits, and our transaction history shows that we bought 64 of the 75 puts at $4. So had a profit in the call option, wanted to protect those profits, so we bought to open the 75 put at 4 points. And that created a market neutral spread, and the 50 strike call option, of course, profits as XLV moves up in price, and the 75 strike put that we purchased profits if the XLV moves down in price. So again, we bought 50 strike call at 960, bought the 75 strike put at 4 points. And we also have a calculator that will calculate the profit potential for market neutral spreads. And let's take a look at this XLV trade. XLV was trading at 71.44. We bought the 50 strike call at 960, and bought the 75 strike put at 4 points. And it will calculate the profit potential assuming various price changes in XLV at option expiration, in this example from a 30% increase to a 100% decrease in price. Now we don't expect the XLV to decline that substantially, but we just plug that in there just so you can see how the strategy works. So we can see from the calculator that if XLV price is flat at 71.44, then we'll realize an $1,100 profit on the spread and an 83% return. A 20% increase in XLV will result in a $2,200 profit and a 162% return. And you can see as the price of XLV goes up, your profit potential also increases. So there's no limit on the profit potential with this spread trade if XLV continues to move up in price. And whenever you can profit, if your ETF is flat at option expiration and you can realize an $1,100 profit and 83% return, that's going to result in a higher percentage of winning trades compared to just taking a directional trade. So we always want to protect our profits with directional trades. And we can see that if the XLV decreases 40%, we wouldn't expect that kind of a move, but this is just as a way of showing you how the strategy works. If it decreases 40%, then we realize an $1,800 profit and a 136% return. And you can see the more it goes down, the more profits it generates. So in this case, the put option is providing total downside protection in down markets. Once we purchase the put, we don't have to worry about protective stops or big down moves in the market, and we just hold this trade until option expiration. So the profit guard spreads can profit if the price of the underlying stock goes up, down, or stays flat. A sharp decline in the price of the underlying stock can result in a windfall profit, and your risk is limited to the cost of the spread. And again, bad earnings reports don't matter. A severe sell-off in the markets doesn't matter, and you don't have to worry about placing protective stops with this strategy. And the profit guard spreads can provide total downside protection during down markets, and there's no limit on upside profit potential, and in many cases the spread can guarantee a profit. So let's just take a quick look. This is a snapshot of a brokerage brokerage account portfolio that shows we had a $901,000 in open trade profits, and this is for the profit guard option spreads and also the profit guard stock spreads. And the report lists the cost of each stock and option, the current price, profit, and percent return. And all but one of the stocks in this portfolio declined substantially after we established the spreads. So all but one of the put options were profitable. So for most of the spreads in this portfolio, the put option was profitable because there was a substantial decline in price. So all of the put options, of course, were in place to protect the profits, and purchasing the put option in most cases for this portfolio guaranteed a profit for the trade. So here's a snapshot, lists the stock in this column. It lists the price paid here, the current price, and then our total dollar gain in this column and total percent return in this column. So you can see that all the put options were profitable except for one, as there was a substantial decline in the market after we established these spread trades. So this protected us in down markets, and we had a $901,000 open trade profit. So we have an option trading service, and email alerts are sent out to members with specific instructions whenever there's a new option trade recommendation, or if we're going to close out an existing trade. We have a portfolio of option trade recommendations, and the prices are updated daily in real time, so members can track the profit performance for every one of the trade recommendations. And we also maintain a closed trade record of all closed trades, so that we have a full accounting of all trade recommendations on the website for our option trading service. And we also make the 6 option calculators available to members of the trading service. So if you want to check option trades before you take them, you'll have the calculators to use as a member. So again, if you want to log on and see how our various strategies are working, you just log on to weeklyoptionalert.com and click the trade results page, and that will list updated profit performance for these various strategies that we trade. Or you can call Brad toll free at 866-661-5664 or 310-647-5664. So we won't have time today to look at the profit guard stock strategy. We'll look at that in another webinar, but I'd be glad to answer any questions, and that will conclude the presentation. So I'll see if we have any questions here. Okay, let me see if I can pull up any questions. Go to community.
Maybe I can help you find some, Chuck.
Yeah, okay.
Just one second. Let's find some good ones. How much is the weekly option service, Chuck?
Okay, that's gonna vary depending on the length of the service, and we have special pricing in force right now. So if you want to call Brad, he can give you that special pricing for participants of this webinar today. So that's going to vary on the time frame of your subscription, and we can let Brad discuss those options with you.
So everyone on the webinar today is getting a deal if they sign up?
Yes.
Oh, wow, that's cool. Awesome.
Yep.
Okay. Let's find some other quick questions. I know we don't have too much time. Someone asked, what is the minimum price of the stock to use this system?
Okay, to use the that depends on the strategy. With the put option purchase, you know, the stock price could be anywhere from $20 or higher for put option purchase. If you're going to trade a put option debit spread, we look at the higher priced stocks because they can produce more profits with the debit spread. So we generally look for the price of the stock to be $50, $60, $70 as a minimum when we establish a debit spread, because that requires a higher price stock to produce more profits.
Okay, interesting. Here's another really good one, because I know that I really like the 1% rule that you're going over. Seems simple and it works. But somebody asked, have you ever tried other percentages other than the 1% rule?
I haven't. We just established that as a general rule of thumb after all those years of trading, we realized that you know, the 1% rule was a good way to minimize the time value, maximize the intrinsic value. If you use a lower percent, let's say 1/2% rule, then of course you'll have more intrinsic value and less time value than if the time value portion was at 1%. So if you go higher than 1%, then your intrinsic value will start decreasing and your time value will start increasing. So we just picked, as a general rule of thumb, the 1%, and we like to see the time value portion less than 1%, and then we know the trade will be profitable if the stock moves 1%. But the deeper in the money you go, of course, the more intrinsic value you have and the less time value.
Okay, good. Do you have time for one or two more quick questions, Chuck?
Sure.
Okay, I like this one. This is a two-part question. The first part is on market neutral, when do you lose money? And the second part of the question that I really like is, what time zone is Brad in? Because that's really important information for everyone who's going to be calling Brad now.
Okay, yeah, Brad is on Pacific time zone. He's in California. And and that first question was for market neutral spreads.
When do you lose money on the market neutral?
Oh, yeah, that's a great question. Okay, so if you leg into a market neutral spread, your risk is when you purchase the call option initially. And when we purchase a call option, we have money management rules, and we'll exit the trade before it develops into a losing trade. We'll exit a trade quickly before it develops into a big losing trade. So normally, if we buy a call option, we'll exit if we're losing 10, 15, 20% on the trade. We'll just close it out before it develops into a big loss. So that's your initial risk. Once you have a profit in a call option trade, then we automatically create a market neutral spread, and once we purchase that put option, in most cases you're guaranteed a profit on the trade. So to answer your question, the risk really is when you establish that directional call option trade initially, that's where your risk is. And we typically will exit a call option trade if we have 20% or higher loss. We'll simply exit that trade and move on to the next opportunity. So that is a good question, because there is risk with the market neutral, and the risk is when you purchase the initial call option.
Okay, great. Wow, very good answer, very thorough. And then the only other thing is I'm still getting a lot of questions from people about pricing and terms and things like that. And I just want to say, I think you guys just need to call and talk to Brad, go over all the options, and then we should be set. Does anyone else have any other questions, or is there anything else that you wanted to say today, Chuck?
No, that's it. I look forward to presenting these webinars, and I actually learn a lot in the webinars from questions I receive from attendees, and over the years that's how some of our strategies developed, by questions that attendees asked, and I did further research on it, and so I actually learn a lot with the webinars, and I'm glad to do it.
Well, this is really fun. I wish we had more time. Hopefully everyone can be here for the next webinar, and we can get even more good questions in. Okay?
Okay, great. Thanks a lot, everybody. Have a great day.
Good night, Chuck. Thank you.
Okay, bye-bye.
Thanks, everybody, for being here. It was a really good presentation. I learned a lot. I bet you guys did, too. And I hope you guys can all be here for the next one as well. Have a great night, everybody.